right, joining us here in studio, we got a special treat for you, kind of an unscheduled, impromptu Clinton Wilkins chat. Clinton Wilkins, hello.
Spur of the moment. Why not?
Well,
I love coming in, so you can have me anytime.
That's how you roll, right?
That's true.
Yeah. As a matter of fact, you've gone on the record as saying you'd like to do my job.
Well, if you ever have a sick day, I put it out there. I'll just do an open hour for 3 hours, or I'll have your guests, and we can talk some mortgage lending too. We can just open up the phone lines. People can start asking me some questions. Why not?
There you go. All right. Well, we'll have to run that by the boss.
I know. Yeah, we probably have to run that up the flagpole. That might have to go up to Toronto. We're not sure.
All right. So Clinton Wilkins, of course, is our mortgage guru, and we co-host a show that's heard twice a month on our radio station, Mortgage 101. I saw this story, Clinton, though, and I thought this is important. This is something that I think that we should get you in to talk about.
For sure.
So I'll read a bit of it. I saw it on the CTV website. With many Canadian homeowners facing a sharp rise in mortgage payments, many of them have decided to bail, resulting in the highest number of Toronto housing units for sale in more than a decade and signaling a big drop in prices in the coming months. What's your takeaway, I guess, first of all, on this?
I do believe that's the situation in Toronto, and I think it's probably also the situation in Vancouver as well. We need to remember that in these markets, people are already very, very indebted, and they were buying maybe beyond even their affordability. And there was a lot of alternative lending happening there because people just couldn't qualify. When B20 and B21 hit, a lot of borrowers that would normally have, had a mortgage from the bank were forced to go to, an alt lender or a subprime lender, for example, to be able to get approved. And those rates were okay. At that time, but just...
What's okay?
Maybe 1 or 2% above what a normal customer would get at the bank.
Interesting.
But we need to remember, even a regular bank mortgages now are more expensive than they were. A normal mortgage right now, we'll say somewhere around 5%. And a lot of these alternative mortgages are being renewed now at, 7% plus. So it's making a big difference in terms of people's affordability. And, I think listing your home when it comes up for renewal is not necessarily a bad thing. And I think these people are self-identifying to say, you know what, I'm going to have some financial problems if I just try to hold on. And I just fear that a lot of people do that. They feel like it's dishonorable to sell your home or, part with your asset if you're not, maybe doing the best financially. But sometimes that's the best thing you can do is sell that property. And right now in Halifax, I will say, there's certainly a lot more transactions happening now than there were maybe the last 3 or 6 months because the rates have softened a bit, and the Bank of Canada is going to be meeting again next week. So we have positive expectations that the rates are going to continue to soften, and a lot of economists think, really over the next 2 years the rates will be 2% less. But the issue is today. And we need to remember that a lot of borrowers are coming out of very, very low fixed rates. Even bank customers and customers that we deal with every single day, they're coming out of rates that are sub 2% and going into rates at, 5%, just for example. And the entire payment's not all interest, but when your interest cost doubles, it certainly makes a big difference. And, here we're starting to see some rumblings of customers coming up for renewal and selling, but not like what we're seeing in Ontario. I think the biggest struggle here is, if you sell your house, where are you going to live? Yep. And, I think that, we do need more housing. And I think some people, will sell here probably over the next 2 years just to, avoid, renewing at a higher rate. And we do need more inventory. So we're not going to see that huge, I think, rush of inventory that they're seeing in Ontario. And I don't perceive that our house prices are going to decrease because we just don't have enough inventory here in Halifax. I read a stat that came out of our the Association of Realtors here for last month. The average house price in Halifax was around $588,000. So that certainly continued to increase. Yes, it's not increasing as fast as it was, in the pandemic days, but home prices, are becoming more balanced here, which I'm okay with. And, I do think that if some borrowers were to list when they come up for renewal, I think as long as they have a good exit strategy, and that might just be buying a smaller home or finding a place to rent, that's okay because we have the demand here in our market in Halifax to eat up more supply.
Why not? But refinance is something that people can. That's a tool if you've got the equity.
Totally. And we're seeing a lot of people that are refinancing at renewal to stay in their homes.
Right.
Now, it's not necessarily refinancing to pull equity out, Todd. Like, and that's what you normally think of. You know, when somebody goes to do a refinance, you think they're going to do a renovation or maybe add a home equity line of credit or pay out some consumer debt. But that's not always the case. Right now, we're seeing a lot of people that are refinancing or changing lenders, for example, just to extend the amortization. And it's not extend the amortization forever, but a lot of borrowers are going to a 25 or a 30-year amortization just for this term.
And taking no equity out.
Correct.
Right, yeah.
And just for this term to lower their monthly output.
Yeah.
And I hear from borrowers every day, people are stressed and people are waiting to the very last minute before renewal. I'm seeing so many people that are renewing, in 4 weeks. Deal with the problem early.
It's not enough time.
It's not enough time.
No.
And some of these borrowers, we have to get to renew into an open term. And let me tell you, an open right now, folks, it's like 9-10% to be in an open.
Yeah.
So you want to avoid being an open term, obviously, if you can. But deal with your problems early. 120 days before renewal is really when you need to start thinking about this. Are you going to do a straight renewal with your lender? Are you going to look to transfer to another lender and hopefully get a better deal? Because, mortgage lenders typically treat new customers better than existing. Are you going to do a refinance? Or does selling make the most sense? And I think it's a great time when you come up for renewal to really think about your personal finances and look at all of that. There's been so many changes over the last couple of years. People's needs have changed. Their whole outlook has changed. So I think it's a good time to look at that at renewal. And sometimes it can just be a reset. And it might not be a reset forever. And there's such I think, a negative connotation to extending amortizations. But if that's what it takes to keep somebody in their home and prevent them from having financial hardship, prevent them from borrowing on a line of credit or a credit card to live, I'm all about it. Let's extend those amortizations. And it kind of brings up a really good point, Todd. We see people going into retirement all the time. And I was always taught you really need to have your mortgage paid off by the time you retire, because how can you have a good retirement? But I think that mentality is changing because the home is typically the biggest asset that a household has or a family has. And leveraging that asset can really help with retirement. Not everybody has a pension these days. Some people are living off CPP and OAS. And I think leveraging that home, even with a reasonable payment, maybe it's $1,000, $1,500, $2,000, you can't rent for that amount now. So, I think this notion of paying off the home before retirement is going away for a lot of borrowers. And we're even seeing people going into retirement that are re-leveraging their properties to either, better their situation, supplement the retirement. And they're okay with it because they're like, I'm okay with this mortgage because I would pay this for rent and I get to stay in the home that I want to be in and the community that I want to be in.
So advice, and you're all about the advice, and that's great, serving the community in a good way. Your advice is get on it. Right?
Act early.
Yeah, act early. Because, if you got 4 weeks, the documents that you need to get together, all of that stuff. It's summer. You have people on vacation. Get on the ball.
Totally get on the ball. I think 4 months prior is the right time. And I think seek the advice of an unbiased mortgage professional, even if that's not who you dealt with for the mortgage that you have. So many differences out there. And I hear borrowers that will walk into their bank branch and say, well, my branch won't extend my amortization. Well, yeah, they want to make the maximum amount off of you. And, if you're not borrowing more money, there's no motivation for them to necessarily rework your existing situation. So sometimes you need to leave the lender that you're with to get what you want. And that's okay. Mortgage brokers deal with all kinds of bank lenders, federally regulated lenders, some that are broker only. And we also deal with lenders that, for those borrowers that can't qualify for a normal, bank style mortgage. And that's okay. We're always about making a plan because, nothing's forever and everybody's situation's different. And sometimes you just need a year or 2 years or 3 years in the situation and then get into a better situation. And that's where I think the advice piece is so important. And you need to have someone that's going to watch it. Finance is not taught in high schools. People don't have any idea really how does a mortgage work. It's virtual. It's in the sky. You don't touch and feel your mortgage. But it's important to seek the advice of someone that really does this every day.
Okay, just got an email from Doug. It says, ask Clinton if it makes sense to refinance to pay for a HELOC.
I am 100% about that all the time.
Yeah.
I think HELOCs in some cases, if they're not managed well, it's a forever plan.
Which is a home equity line of credit.
Home equity line of credit.
Yeah.
So there are borrowers that have just a home equity line of credit on their home. Currently, the federal government allows lenders to go up to 65% of the market value for a home equity line of credit. And it is typically a forever plan for a lot of people. The rates could be anywhere from prime to prime plus one, just depending on the lender and, your circumstance. But typically they're an interest-only payment. And borrowers, by and large, will pay the minimum payment. It's tough sometimes to part with that, the principal. And it doesn't force people to pay it down. So oftentimes we'll see borrowers that are in, a HELOC type product, and then we'll take it out and into a standalone mortgage, even at a 30-year amortization. Payment's not that much more, but at least they're starting to pay down some principal because you're getting a much lower rate with a mortgage than you are with a home equity line of credit.
All right, and reverse mortgages, this is something that people talk a lot about. It's advertised a lot of marketing around this. What advice do you give people when it comes to a reverse mortgage?
If you're 65 years old, a reverse mortgage is probably not working for you.
Is that right?
If you're 80 years old, giddy up.
Is that right?
And, it depends if you're a man or a woman because there's different stats on how long you're going to live.
Sure.
And it depends if there's two people on the application or not. It depends where the property is. But typically, for example, CHIP, that's one of the ones that we deal with, they will lend a very small percentage of that property value. When borrowers come to see me, typically in retirement, because that's who would be getting a reverse mortgage, sometimes a home equity line of credit makes more sense, just depending on their situation and if they can qualify and how their credit is. A CHIP mortgage is better sometimes for people that need to supplement their income, or their income is very low, or the credit's maybe not that good, or they're very, very old. Because the older they are, the more a company like CHIP will lend to you.
Yeah. Okay. And of course, if you've got dependents and kids that you would like to pass some,
maybe a different situation.
That needs to be considered as well.
Correct.
Again, so many layers to mortgage lending, like you
say.
So
complex.
Right?
It's the most regulated industry, really, in banking and in finance. If we dot every T, cross every T, dot every I, and literally every single piece of paper is audited. There's many eyes on that paper, and it's really the federal government is trying to protect borrowers from themselves and protect the banks. And we're all about that too. But there are a lot of nuances and differences between lenders, and it's not just a rate. And, I think there's so many misconceptions that the lowest rate is always the best rate. It's not. And you really need to figure out, what is your game plan?
Right.
And, where are you going in your life? Because depending on your situation, the advice really is different. Yeah. And the advice changes, Todd. Honestly, the advice changes. Let me tell you, we have never done so many variable rate mortgages as we have the last 2 or 3 months. People are coming and knocking for a variable now. And I expect, once next Wednesday hits and there's some news from the Bank of Canada, and if they continue to cut that key overnight rate, the variable rate mortgages will look much more attractive, I think, than fixed.
All right, Clinton, thanks for coming in. I appreciate it, pal.
Thanks for having me, Todd. Happy Friday.
Indeed. And we'll talk soon.
Chat soon for sure.
All right, that's Clinton Wilkins, our mortgage guru.